Let me introduce our featured speaker, my business partner and our president, Mr. Carl Frank. I'll brag on him real quickly. You know, Carl focuses on the unloved business owners in and around the Denver metro area. I've been doing it for a long time now. And not only is Carl very respected here in our office, but he really is considered a leader and a giver in our profession, which we're really, really proud of. Couple highlights here. Carl was nominated by his peers as a leader in the profession, was featured in the Journal of Financial Planning for going the extra mile. He serves as a resource for nonprofits through Social Venture Partners. They're a philanthropic partner of the Denver Foundation. Carl served as the ambassador for the National Certified Financial Planning Board since 2014. He's got an encyclopedia of letters behind his name, including his Certified Financial Planner designation and 3 different master's degrees, which he earned at University of Colorado Boulder and Denver University. And he's a really fun guy to get to listen to. So I'm sure he will keep things light and humorous. And without further ado, I'll hand things over to you, Carl. Good luck.
Thanks, Chad. Yeah, good luck is right. Oof, I appreciate that. Thanks, buddy. Appreciate it. That was really kind of you. I don't know how fun this is going to be. But we are going to talk about investments, which I love. So thank you for being here. You know, this is a big part of what we do. Let me just begin by letting you know that we provide you a second opinion service. As a service to you, we'd love to meet with your friends and family. Anybody who you know might have an investment question or a financial planning question, please take the time to introduce us. We've got a 2-dimensional barcode here. We'll see it again at the end. You just take a photo of that and send them that link, and then you'd be able to help your friends and family out. And we provide up to 3 meetings free of charge. So take advantage of our second opinion service. Okay, here we go. Wow, holy cow. I mean, Chad said it'd be fun, but I don't know how fun this is. I mean, we live in a world that's full of fear right now. There are so many things that we're worried about, and some of them are written on this wall here, but the markets, inflation, economy, the war breaking out around the world, Ukraine, China, Israel, right? All of these things are terrifying. Many of us are worried about how we're going to afford healthcare, retirement, and our kids. We're all worried about our kids. What kind of a future are we leaving them? If I asked, you could probably come up with a lot of other things that are on your mind that you're worried about today. And I think that wall of worry that is painted in front of us is something that is predominantly driving a lot of decisions today. And what you'll find as we come through the end of this presentation is that investment markets climb a wall of worry, that they do really well during these times of uncertainty. And I hope that you gather that from today's presentation, that our investment researchers are a little bit more positive than they have been in a long time. So we'll talk about that. We'll talk about the concerns. We're going to start actually with the recent returns and then talk about the bad news. But I think you're going to find that there's a lot of good news. And we're not exactly changing the perspective here. We're just opening up to the facts that are out there already. So I hope you appreciate it. I hope you appreciate our perspective today. You take notes, and all of you online, use that green chat box at the bottom to ask your questions, because we'll be done a little bit sooner today than some of our recent lunch and learns. So we'll have lots of time for questions. Okay, so where have we been with investments? Well, here they are. So we'll just go from left to right, and we'll start with the bad news that bonds during the first quarter, now this is all through March 31, but bonds actually had a rough start to the year. We'll talk about the reasons why next. The middle section, all of the equities are all positive. In fact, the large U.S. companies, especially these technology companies, continued the rally that they were in from last year. And so they began this year with an astonishing 10% gain in the first quarter. And all the rest of the equities are in the 2s or 5s all around the world, whether they're small cap companies, developed international, or emerging markets. Their returns were also really good. If you annualize those numbers, I think we'd all be really happy. And the best performing category, surprisingly, always surprisingly, the managed futures or the alternative investments that some of you might have in a small sleeve of your portfolio, which ended the year or ended the first quarter even a little bit higher than equities. Well, that's where they were through March. April, if you watched or read yesterday's Periscope email, was pretty dramatic with a lot of ups and a lot of downs. And unfortunately, I think that's probably the future, for at least until we get through the election in the U.S., but maybe even a little bit longer after that. Volatility is something we're going to have to become comfortable with. This uncertainty that we're facing right now is not going to end anytime soon just because we want it to. So the less you look, the happier you'll be. It'll be a theme for today's conversations as we go on. So the reason that bonds had a rough start is because the Federal Reserve did not do what they said they would do, or at least the way that the market interpreted what the Fed said they would do. If you actually look at the words that the Federal Reserve has been parsing out over the past year, you'll say, well, maybe we'll raise rates, maybe we'll lower rates, maybe we'll keep them the same. But what the market said was, lower rates? You're going to lower rates? We're going to lower rates. We're going to bet that you're going to lower rates. In fact, what this chart is showing here, on the left-hand side, this is how much they thought the rates would lower by. Right now, a key interest rate called the federal funds rate is at 5.5%. That's the highest it's been in a very long time. That, by the way, is a historical average. That's a good rate. That's not a abnormal average, except for the past couple of decades. You can see that 70% of the Wall Street forecasters thought that the rates would drop to as low as 3 and as high as 4%. 70% of them thought it would be a lot lower than it actually is right now. And we're 4 months, 2 weeks, and 3 days into this year, and we don't have any signs that they're going to lower rates soon. At the end of the third quarter, the gold bars you can see on the right hand, oops, we're on the wrong slide. This slide here. The expectations for the Fed funds rate were that they would lower a lot lower. They did, but the gold bars on the right-hand side, you can see that they've expected maybe they're going to lower them a 1% during the year, which still seems optimistic to a lot of people, right? We're at 5.5 now, and 70% of them think that the rate will be at least 4% or higher calendar year. So when the market anticipates something and doesn't get it, they start to sell. And so bonds suffered a little bit at the beginning of the year. That being said, we came into this year, everybody was excited about bonds. All the investment professionals said, we're going to invest in bonds. This is a great year for bonds, blah, 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 blah. Right? They didn't make a mistake. Right? They just, explored alternative investments and put all their money in other places. So there's no fact about the future. That's one of the most important messages that we can have today. So I'm going to present to you the forecasts from IM Global Partners, as well as from Athena Invest, our two big research partners here at ANI Wealth Management. We're going to be a little bit humble and we look back at it and say, although our researchers weren't that far off and they were in good company, nobody knows the future, right? Nobody knew that inflation would stay persistently high and higher than the Fed wants it to be. If you look at the most recent end of this chart, now this chart goes back to our lifespan. This chart starts in 1948. You can see that where we're at now at that little line is about average. It's not a bad number to be where inflation is today. In fact, today's inflation number came out as the lowest monthly number in a while. It was good news about inflation. Because inflation is still above the average that the Fed wants, they're not lowering rates. Other thing that's driving the economy today is that the Fed sees good growth. And so while we're looking at the Federal Reserve, we're worried. Are we saying, oh my gosh, when are they going to cut rates? How is the market going to respond? But the Fed sees good growth and it sees above average inflation. And so they want to keep interest rates high until they do. And our research team at IM Global Partners think maybe perhaps the Fed's already entered what they call a restrictive Federal Reserve phase. And what that means is that they're actually slowing down the economy already. So what this is showing on the chart are two lines, and the blue line being negative is showing you an inverted yield curve. The inverted yield curve is a predictor of recession. So when it's down, that means recession. The other line is the real Fed funds rate. That's the rate 5.5 minus the inflation rate, which is somewhere around above 2, about 3. And when those are opposite like they are now, then recessions usually follow. And that's what this chart is showing in these gray lines. And so there's a little bit of predictive indicators here. Again, there are no facts about the future, but the IM Global Partner team expects more volatility ahead. Because of that, they made a decision with the portfolios that you might have invested with us to be a little bit more in equities that are a little bit more safe during periods of heightened volatility. So that was a decision that they made in March and that we acted on for many of our clients. So this restrictive Fed is the bad news, right? Inflation is the bad news. And those are the things that are concerning to us. But the other half of this is that the economy is growing, which is the good news, right? And this is one of the indicators that I Am Global Partner looks at. It's called the Bloomberg Financial Conditions Index. And I've got a nice quote on here describing what it is. It represents a comprehensive array of risk indicators, including interest rates, credit spreads, equity market performance, and currency movements, which is a long-winded way to say, well, maybe we're going to make a mistake, but we're going to have all this information and give you the best chance possible. The mistake will be as small as possible, right? And so that's showing that this is as good. If you look at this, the higher this number is, the better it is. And you can see how bad it was during COVID, right? You can see how bad it was during the financial recession. Really, really bad. But you can see that that's as high as it's been pretty much since the beginning, and definitely in 4 years. So the Bloomberg of the world says things look good and the economy is in fact growing. The second thing that looks really good is what's called the conference board. Now, I think pretty much every one of these I've ever done, we've talked about the conference board, or at least talked about the leading economic indicators. It's an academically tested, long time standing, useful indicator that the market used for a long time. It's got a long track record. It looks good. Leading economic indicators are breaking into the positive, and you can see that zero line, which it just broke above, is the first time in March it had been that high for a long time. That's on the other hand, right? Things look pretty good. On yet another hand is April made it look bad again. So it didn't go down by a whole lot, but it's not as good as it was at the end of March. So things are changing even since I gave this presentation. And the fun thing is that I'm going to give this presentation again in August, and then I'm giving it in November, the day after the election. So it'll be a completely different story in November, but I have a feeling that you've got a prequel, you've got a predecessor that you can predict what I'm going to say in August. Well, we still don't really know, right? Because the economy is looking pretty good, but the Fed still isn't lowering rates. And so the markets are predicting that, anticipating that, and looking into the future and seeing things as being really good. But it still feels bad for us because we still don't have a big decision being made. And we still have wars and all these things around the world that we're worried about. And inflation is still persistently high. And that's something that we feel as consumers. Given all that, I'm Global Partners believes that equities are going to be able to climb that wall of worry. And this is the history that it shows. And you can see the blue line is largely where we spend our time going from bottom left to the top right with short periods of little yellow decline. But look at where the gray bars are. These are, again, the recession periods of time. And equities climb right through it. Well, the recession is not a predictor of poor equity returns. In fact, equities often do really well during these rough periods of time. So that even if the Federal Reserve overshoots and causes a short-term decline in the economy, equities are still a good place to be. And this is one of the reasons why Littman Gregory, now known as I Am Global Partners, says this is a good time to be a long-term equity investor, that it's a prudent decision to maintain a full allocation to equities in your portfolio today. The other good news about equities is that it's broadening. So like we were talking about in January, and we talked about most of last year, a large part of last year's return in U.S. equities was driven by 7 companies, these 7 huge technology companies, Tesla, Amazon, Meta, formerly known as Facebook, Google, NVIDIA was the huge driver of that, and a couple of other firms that we've all heard of. That is broadening out. More companies are doing better than they were last year. More companies are making higher earnings, and their equity prices are starting to reflect that. And this is very good news. This is good for all of us because we're not just going to have in our portfolio these 7 hot stocks from last year, right? We're going to have a broad array of investments that will do good in the future. They have good earnings already and all the things that we look at. And you've heard me talk before about our strategies and how the right way to invest is to diversify by strategy. We're going to have other companies in there. And what this chart is showing you is that the price that you pay for these huge companies is pretty high. You're paying $30 for every $1 of earnings if you're buying one of these large companies, and sometimes significantly higher than that for others. But for the rest of the market, you're still at 19 times earnings, which is close to average. Maybe a little bit high there too. As earnings come up, PE get back to normal. These are good times to be an equity investor and be a diversified equity investor as well. And if you compare the US, I put that in red, to the rest of the world, see, it's not the same story, that the US equity market has shot through the roof. It's almost the same slide I had last quarter and quarter before that, where equity prices in the US are going through the roof. Everybody loved the US, and now that's broadening out across the world. And these are great times, again, to be a little bit diverse, because you've got all these other things on sale. If two companies are producing the same product, but one sells it for a lower price, you're probably going to buy the one at a lower price. It's the same philosophy that we want to use when we're looking at investments. If you can take the same amount of risk but get a potentially higher return, it's a prudent decision to put your money there. So we're back in our long-term equity allocation position here at ANI from IM Global Partners. We're not making a bet too much on international or too much on emerging markets or too much on small companies or anything along those lines. We're back in a long-term prudent position. Most of our clients, most of the money for most of our clients. Another really important point is China. So China is making the news and will likely continue to make the news because they're becoming less investor friendly. And so this was a decision that, and China represents 25% of the MSCI equity markets all around the world. If you add up all the money, the US is close to 60% now, but China is by far the second largest at a huge portion of the MSCI, excluding the US. It's a big, big number. But they're becoming less and less investor friendly. Apparently, they want all of their money to stay in China or something along those lines. And so they're making it harder for the rest of us to produce and consume products from that country. And as that happens, it becomes less and less appealing for investors. With all of the drama that they've made the news recently, that is likely to continue. That plus the fact that, and they're still considered an emerging market. I could be the second largest in emerging, is a matter of math, way above my pay grade. But that not being good in China, and the other fact that emerging markets, which is really doing well, but they've reached a point where their prices are about average, according to that other chart, is a good time for us to not overweight emerging markets. So we're back to our long-term strategy. In an average client portfolio, your exposure to any of these areas is much smaller than it would be in the past. So those are some of the recent decisions that we've made. It was a busy quarter for us. The next thing I want to talk about are bonds, and many of you know I'm an equity investor, but I persist with bonds. I put up with them. Now, many of you have a lot of money in bonds, and many other investors on our team are better qualified, quite frankly, to talk about bonds because they spend much more time thinking about it. But right now, I have to admit, bonds do look attractive. There's something called the equity risk premium, and that's just saying, if I'm going to put money into an equity which bounces around, the prices move around based off whims of Wall Street, but over a long period of time, go up much higher, then I'm taking a risk, right? And if I can get a good rate of return without that bounciness, a bond, then I'm paying a risk premium is what it's called. It's a fancy way of saying how much more return am I going to get for taking that much more risk. You can see right now, it's lower than it has been in a long time, that it's actually a good time to be a bond investor. Now, this is not a predictive indicator, right? I would not use this to say, okay, let's move everything out, because it was wrong in the first quarter, right? It looked good a while ago, and bonds still delivered a negative return, but it was a very short period of time. And as that happens, it's a good time to be a long-term investor. You're actually getting a rate of return in your checking account and your savings account, or maybe not checking. But anyway, the banks are trying to compete with bonds now. Bonds are still, as I'm about to show you, delivering a much better return than what you're going to get out there in their yields. But the situation is such that finally we're back in a normal position. It's a good time to be thinking about retiring or already be retiring and wanting that fixed income to keep you alive and maintain your lifestyle, because you're finally getting some returns from some of these non-risky investments. These non-equity investments are delivering good returns. So maybe things are a whole lot better than we think, right? Maybe things just feel really bad, and we're exposed to all sorts of artificial intelligence that only exaggerates. The algorithm only looks at things that we continue to click on, and they continue to look worse and worse and worse. Maybe things are actually really good underlying. There's a chance that that's the right perspective, and that when we look back at life in the future, We're thinking to ourselves, wow, these were the good times. These were the good times. Okay, so here are the bond yields. And the most recent quarter, every bar is a quarter, and every set of bars is one of the investments that you might see in your portfolio. And the gold bar at the very end is the most recent. You can see it was, for many of them, a little bit higher last quarter, but it's significantly higher than what you'll see in a lot of other places. And a lot of these investments are delivering really nice yield, a really nice income every year. It's a nice place to have your money with a lot more stability in the price than you can find other places. So this is a good time. It hasn't been long that we've been able to say that. There's been a lot of years where we've said that your bond yield is not exciting. You're getting about the same yield there as you're getting from your dividends in your equities portfolio. Well, that's not the case anymore. Not the case. All right, this is one of my favorite charts. It's one of the most confusing, but I always come back to it because history is the only guide we have. So every row is showing a period of time when the Fed stopped raising rates. The oldest rows are at top, and the most recent Fed stopping raising rates happened in July of last year. They stopped raising rates almost a year ago. You can see what the markets have done after that. And most recently, you'll see on all the rows in the bottom, the most recent periods of time are large positive returns. And you can see one column shows 3 months, one column shows 6 months, one shows 9, one shows a year. And that's largely due to the fact that the older periods of time, we had much higher inflation than we do today. Remember that inflation chart? It was much worse in the past. Like we're still at about average, maybe even below average historical American inflation rates, but it's been higher than it was recently. In periods of high inflation, maybe the equity markets don't do as well. In periods of low inflation, like we're at right now, where the Fed is refusing to lower interest rates because they want it to be even lower, equity markets have in the past done really well after the Fed is done raising rates. And so to the extent that the Fed drives anything, or the extent that you're worried about the Federal Reserve, I hope that you can take this and say, well, you know, in the past, actually, when they're done doing that, things look pretty good. And one of the most famous examples of that happened when ANI was founded in 1986. A few years before that, Paul Volcker was in charge of the Federal Reserve, and Ronald Reagan had just become president. And Ronald Reagan was famously fighting with Paul Volcker to stop raising rates. And Volcker raised rates and raised rates and raised rates and raised rates. And many of my clients have told me stories about getting their first mortgage at double-digit inflation, a double-digit mortgage rate, 11%, 12%, 15%, I've heard, were some of the rates that people were paying for mortgages back then, right? And what happened when he raised rates and those mortgages were so crazy expensive, it broke the back of inflation. Inflation came back to normal. They were able to lower the rates, and it swept in one of the best equity market rallies in the history of the world. 80s and the 90s possibly were the best period of time to ever be an investor. Well, we might be in a little mini version of that today. As we fight inflation, and we've raised rates, and it looks like we've stopped raising rates, we could be looking forward to something really good and exciting for a pretty long period of time. There's a possibility there that maybe you're not hearing from other people that I want to present to you. This could be much better than you think, even though we've got that big ugly wall of worry, all the graffiti with all the reasons to be fearful on top of it. All right, so here's the other hand. So I talked about the bad news, we still have inflation. Bad news, we haven't lowered rates yet. Bad news that we started out a little rough for bonds, but great news for the equity markets, great news for other types of investments, great news on the growth of our economy, and mediocre news about the world, right? That there are opportunities out there that are much less expensive with good growth happening outside the U.S. And so we want to have a little bit of money there and be a little bit humble. On the third hand is Athena. So Athena is a kind of firm that is different than IM Global Partners. We use two different research firms, and they don't always agree. Athena divides all of their patented research into 4 categories, and really their patent is in that first set of box, the behavioral area. And the behavioral area is green, it's good. The investors are behaving in a healthy manner, that we've got optimism. This is where they do their work. And this is how they've patented it. And so that, you know, behind the scenes, we'd be happy to send you the investment philosophy and you can read it and understand it. But the bottom line is Athena is very optimistic in their patented area. The second category are the economic indicators. One of them is the LEI, right? And they're moderate. They're moderate. They're not great. But they're in the okay range, which is good, both for the stuff we touch when we buy it and the services we acquire, which is an increasingly larger part of our economy in America, things we don't touch, but we spend money on. The third category is valuation, which is really looking at the price of equities per unit of earnings. Well, the prices, as we know, went up a lot, and earnings have also gone up. It's a little bit above average, and so you can see there's some caution there. It's not a full out, this is crazy, Bill, but as earnings increase, even if the prices stay the same or don't increase as much, that'll get back into the normal and green ranges. So this is really, valuation is good news, even though it says caution. And the fourth category is the technical indicators, which is all green. The market's largely all up. This is as of yesterday. I updated this yesterday because I was really interested to see how April would have affected that, because April was both really down and really up, and we ended about where we started. It was a lot of drama over nothing, as usual, in the markets. Don't pay attention over short periods of time. It does nothing but cause you stress and make you lose hair. I looked at this 20 years ago, and I had hair. It was crazy. So that's the bottom line, right? You've got two different sides, but mostly this is okay, right? And our global partners are looking a little bit different perspective, but they're saying mostly it's okay. And our wall of worry says, well, the markets climb a wall of worry. So things look good. On the other hand, there's a lot to worry about. I'm going to give you the best piece of advice I've got. Like this is the number one investing, and quite frankly, it's a good life skill to have. It's easier said than done. I don't recommend you just go around bossing people around, telling them to do this like I'm about to tell you. So forgive me that. But don't worry. Right? It's just causing twice the pain. So if you worry about something bad about to happen, you're causing yourself pain right now. If the bad thing happens, then you feel it twice. You feel it again. Right? But if you worry about something bad happens and then it doesn't happen because you're like everybody on the news, everybody in social media, then you've caused pain for no good reason. Right? So let it go. Let it go. Focus on what you can control. You'll be a lot more successful investor. So the investments that we have invested for you, your financial planner has spoken with you and customized it for your unique situation. That the situation that you're going into, you're planning for. That they've helped other people in similar situations, and they've got the experience to make sure that the investments are not going to blow that up. That you'll be there when the money will be there when you want it to be there, right? That's what you can rely on. We're doing a lot in our firm, and you'll find out, real soon. I hope, if you haven't already, gone to our website and looked at all the other things we're doing. One of the big initiatives that we've launched this year is the aging planning, the elder planning, and I hope your financial planner is talking to you about it. We've done podcasts on it, we've done videos on it, we did lunch and learns on it, we got blog posts, and that'll help you, I think, cover a lot of the worries that you might have in your own life. Make sure that, oh my gosh, we're all going to face a period of time when we really do depend on somebody else. And what can I do to make sure that they're not burdened and honoring my wishes? It's one of the many things we do. So share this, share our website, share all the resources that are on the website with the simple link. This is the barcode. We do our weekly newsletter. The newsletter yesterday had about 500, maybe 600 words about what I just said today. So you can share that. You can easily forward that out. This video will be on the website next week. We've got the blog. The blog posts are all over. Our young paraplanners are in the back. I hope you don't mind me calling you young, because everybody under 40 is young. Yeah, but yes, they were amazed when they looked at our website and said, oh my gosh, there's so much stuff out here. And I said, yeah, I know, I need your help to organize it. Yes. So there's a lot of information on the website. The videos, every one of these is out there on our website or our YouTube. And then finally, the podcasts are available anywhere that you listen to a podcast. You'll hear us interviewing smart people. So if you're tired of my voice, you can still listen to the podcast. I'll just be asking questions of experts. And the most recent one is Annalie Kruger on aging planning. But another recent one was on tax planning, because there's a big set of tax rules that are happening in America right now that we kind of forgot about. And they were passed 5 years ago. And so you might want to, if you're a business owner, it really probably does affect you. And so you might want to I'm going to conclude with that. It's not as bad as you think. Worrying about it only causes twice the pain. Inflation is not as bad as it has been in the past, even though it really does stink. And that is the primary reason why we're not getting a lot of the good feelings, quite frankly, we deserve, because the companies that we're invested in are profitable. That's my president. I told you to be short. Isn't that bad? All right.